Currency correlation. In this video, you will learn what currency correlation is, which pairs have a tendency to correlate, how currency correlation affects you when trading more than one pair at a time, and how we can use market correlation to trade. Just as there are relationships across different asset classes, there are also correlations that exist between currency pairs. Currency correlation exists when two or more currency pairs rise or fall in relation with each other. When demand for one of the currencies in the pair is rising, it may rise against other currencies too. If there is a large demand for euro, for instance, both the euro dollar and the euro yen could rise. Let's explain positive correlation using the euro and the dollar. If the euro dollar increases in value on a price chart, this can mean that either the euro is in higher demand or the dollar is in less demand. If there is more demand for the euro, then there will also be more demand for the euro against other currency pairs as well. For example, if the euro dollar increases in value because the euro has become stronger, we can anticipate the euro to rise against the other currency crosses like the euro Australian dollar and the euro yen. The same supply and demand factors result in negative correlations between currency pairs. For example, if the demand for the dollar increases, then the dollar yen will rise, whereas the euro dollar will fall. This is because the price of the US dollar is denoted differently for these two currency pairs. Currency correlation can affect you when trading more than one pair at a time. First of all, there's the increased risk. Let's say that you risk 2% of a trading account on a single trade. If you open a long position on both the euro dollar and the pound dollar, then it would appear that you have opened up two trades, with a 2% risk on each. However, because there is a strong correlation between the euro dollar and pound dollar, if one currency pair moves rapidly in one direction, the other is likely to do so as well. In this example, the dollar is in higher demand, causing the euro and the pound to fall. Therefore, you have effectively risked 4% of your account on a single trade, because these currencies are likely to move together. Correlation trades can also cancel each other out. If a trader opened up a buy order on the euro dollar and a sell order on the pound dollar at the same time, the dollar price could influence both currency pairs, resulting in a winning trade on the euro dollar and a losing trade on the pound dollar. Then, any profit made on one trade would be offset by the loss of the other. This is due to the correlation our trade has with the dollar. Similarly, if a trader opens the same position on a negatively correlating pair, such as the euro dollar and the dollar yen, then any profits gained in one position are likely to be wiped out from the loss in the other. In this example, the dollar is in a higher demand, pushing both pairs in opposite directions. A helpful way of measuring the correlation between currency pairs is with a correlation table. The financial industry generally measures correlations using a scale from +1 to -1. +1 equals a perfect positive correlation, -1 equals a perfect negative correlation, and 0 equals no correlation at all. In order to actively use currency correlation in trading, you should start by looking at three pairs. You look for whether the pairs that are correlating are moving in proportion to the pair that you are watching. Correlation is never exact, and so we look for the same kinds of moves, but not exactly the same moves between the currency pairs. In this example, the US dollar was gaining strength versus the euro. This was confirmed by the British pound US dollar and Australian dollar US dollar pair, both in a strong downtrend, with the US dollar gaining strength. The three charts show similar behavior and confirm that a sell entry in the euro US dollar was a high probability trade. By observing the same three currency pairs, a trader can use currency correlation to find entry and breakout signals. Let's say we notice that after trading in a range, the Australian dollar US dollar breaks out of the range to the downside, and we feel that currency pair will continue to trade to the downside. We can look at the euro dollar and pound dollar and see that there is no noticeable move substantiating the dollar strength in this case. We may not wish to sell the Australian dollar US dollar until we see more confirmation from the other two pairs. So far, you have learned that just as there are relationships across different asset classes, there are also correlations that exist between currency pairs. Currency correlations can be positive or negative. When trading more than two currency pairs, not understanding currency correlation can lead to an increased exposure of a trading account or the cancelling out of a profitable trade. Once currency correlation is understood, it can help the trader decide if a trade should be taken or not.